Eliza, thanks so much for joining me today.
Thank you for having me. It's great to be here.
Yeah. So I thought it'd be really good, obviously, having an economist and having that point of view. And then from day to day, us managing so many properties. And, I'm more of a gut feel. So I thought it was like, you've got the numbers, and then I can talk about the gut feel. And I'm really feeling this can really, help our listeners.
Yeah, I think so. It's good to have your on the ground experience as well. There's only so much I can get from numbers in an Excel spreadsheet.
Yeah, and I also thought there's a bit of a delay. Like there's nothing like an auctioneer. Like you're actually out there on the field, you're seeing people bidding. And even it doesn't matter whether, it might have got 5,000 under reserve, it might have sold 20 under. So the numbers might say one thing, but I always say it's about the faces or their reactions or how they feel. So for our viewers being the first time, can you just give us a bit of your experience, just so people know what they're going to be listening to every month?
Sure. So my background is in economics, but I've always worked in property data,
Yeah.
specifically the residential market. I've been doing that for the past 10 years. So I think it's given me a pretty good gauge of what to expect in terms of a market reaction when you get fluctuations in interest rates, economic performance, and consumer behavior.
Beautiful. So I did economics in year 11 and year 12. And when I see RBA raise rates, and in the same paper it talks about a recession, my year 11, year 12 doesn't understand that, because to me that's the complete opposite. That makes no sense. How can we be having a recession but raising interest rates? So obviously I need to do a bit more study. So I think they use the word stagflation, but can we just talk about that? 'Cause I think that's what we're all talking about. How can we talk about a market struggling? We're talking to a lot of mums and dads with, they're struggling a little bit with money, but then talking about rates to slow spending down. Can you talk about that?
Yeah, absolutely. It's kind of a unique situation that we're in at the moment, where interest rates kind of have to rise because the economy started performing really well in 2025. We saw a pickup in demand, GDP growth started to improve. But what happened is that growth in demand butted up against capacity of the economy to deliver for that additional demand. So capacity constraints are things like the amount of floor space that a factory has to produce goods and services, or the amount of staff that a business has. At some point, your economic demand gets high enough that businesses actually need to increase their prices in order to expand their capacity and satisfy that demand. And as you may remember from your economics classes in high school, when businesses start increasing their prices and customers need to get wage increases to meet those higher levels of price, that's where your inflationary spiral starts. And that was happening even before the fuel price shock that we saw from the conflict in the Middle East, and with expectations that oil prices are going to see further disruption, and they are already flowing through to price increases for Australian consumers. That only increases the prospect for higher rates and prices to stay stickier because of those increased fuel prices. So that's your high inflation, high interest rate element. Because of high interest rates, it's going to curb demand, which is where you get the softer economic growth, loosening labour market, and that's how we get into this position of stagflation.
So obviously we talk about a strong economy. It's a big question, but it seems like big business is doing well, but little business is struggling. Like, we've got such a cross-section from Foster to Brunswick Head, and we meet lots of business owners. And there's no one like saying, hey, Dave, I've got X amount of money. I need to really spend it really quick. Like in other markets where you see other, really strong economies and you see a lot of people with cash and a lot of people wanting to invest. It seems like the rough sentiment up and down the coast is that people are doing it a little bit tougher. So are we going to see a gap with big businesses to smaller businesses?
Yeah, I think so, because big businesses have greater ability to scale their costs, to implement productivity measures to try and cope with increased costs. So Metricon is a really interesting example of Australia's biggest home builder who have said that They think because of the way they've set up their supply chains, for example, they can somewhat mitigate the cost increases, whereas smaller operators, certainly smaller suppliers in the construction sector are struggling. And I think smaller tourism businesses as well might find the short term quite challenging as interest rates rise, consumer sentiment dips, and people kind of draw the strings of their purse tighter. Is that the same? Draw strings on the purse?
Yeah, a little bit, yeah.
So, yeah, there is a challenge. And I think for lower income households as well, which tend to represent parts of North Coast New South Wales, will be the other segment that struggles quite a bit. I think, offsetting that, a looser labour market will at least ease some of the hiring capacity pressures that businesses see. But, we've got to engage with the reality, which is in the short term, both higher fuel costs and higher interest rate means the economy is going to take a bit of a hit.
Yeah. So as an avid property investor, I'm always a little bit optimistic that they'll get it and the rates won't rise like they, the 2 or 3 like they're saying. The other thing is I've always felt that, in history, the RBA's either been too aggressive either way, and they seem to always get it wrong. I hope the RBA aren't listening, but it always seems that, they're 1 or 2 rate rises the wrong way and then they react quicker. And then the other thing I'm noticing, I've spent a lot of time listening to Mark Burris, is that the mortgage belt is smaller and smaller these days. So once upon a time, every 22-year-old to every 50-year-old roughly had a mortgage, but obviously that gap is smaller now. That a lot of people aren't getting a mortgage till they're 30 or vice versa. One, do you really think there'll be 2 or 3? And then would I be right in saying that these days, even if we see 2 or 3, that the RBA could be just as aggressive dropping them again, that we're seeing more aggressive moves than we saw maybe 5 or 10 years ago?
Yeah, this is a really good point. So the 3 additional rate hikes from May, June and August was forecast first by Westpac. And this is, they're headed by Lucy Ellis, who is a former RBA economist and insider as well. Their assumptions for this base case are that the Strait of Hormuz is closed until the end of April. And we know that there is a very fragile ceasefire. Now Donald Trump is trying to get more bargaining power by just blockading the strait as a whole. There's a lot of... So that's really where this idea of higher for longer interest rates is coming from, is that greater disruption to oil supply and greater increase in fuel costs. I think we need to be realistic. It's tempting to be optimistic, but the base case scenario of what will happen isn't always what we hope it will be. Sometimes we just have to be realistic about the extended conflict. The good news, as you say, is that because Australia didn't cut as much as other countries, because we were one of the first countries to increase rates, I think we are braced for tighter monetary policy and we have more room to move when inflation does get back into target. And the RBA can fairly quickly adjust interest rates accordingly. And it really is that long-term view that you want to take, especially when it comes to the housing market, because it is a long-term asset. And if you look at some of the biggest returns through the late 2000s, they came from the height of the GFC. If you look at some of the biggest returns in the past 5 years, it would have been if you'd bought in early 2023 after 8 rate hikes when the market was at a little bit of a dip. So for those who they're well capitalized, they hold steady in their investment strategy, and they look through the short-term volatility to the long-term capital growth potential, they're going to be poised to benefit most from the current situation.
I mean, obviously I'm a bit biased because I'm in property, but what I've been saying to a lot of clients is who knows how long uncertainty is for, but I know after every bit of certainty, after uncertainty, there is a mini boom, or at least a boom. So, who knows what that time frame might be. But I think if history says one thing. The last question is about interest rates, because I was lucky enough to speak to a very high person up in Citibank and talking, other parts of the world, interest rates have been going down, and we're the only real economy in the world looking to go up. Since the fighting over in the Middle East, is any other country looking to raise rates, or only Australia?
Yeah, there is some hawkish language coming out of the ECB, for example. I think if these pressures persist, then central banks around the world may have to start rethinking their rate strategy. The fact that we've gotten in early gives us the benefit of a higher dollar. You raise interest rates, it attracts more capital inflow, so people have to convert to Australian dollars to take advantage of those higher interest rates and get a return. That pushes up the dollar and helps to reduce imported inflation. So I think in that sense, we're kind of well placed. And I think we'll also start to see other countries following suit if the conflict drags on and oil price surges drag on.
Yeah, great. So we had some other topics talking about the North Coast market, which we'll touch on really quickly, and then tourism. The big one that I'm talking about more than anything, more than inflation and interest rates, is the budget. And, lots of people are saying they've got inside information. I mean, I don't know how anyone has inside information to a budget. When we're talking about negative gearing, have you got a view on what might come out of the budget, or you'd rather just wait and see when it comes to capital gains? And I mean, that to me could be the bigger news than anything this year when it comes to property.
That's a really good point. And I think it's not something that a lot of people are talking about in the context of short-term demand changes. I think the government, as any good government does, they kind of give you a little bit of a primer on what to expect. And there have been hints at intergenerational inequality, bold tax reform. So, I think people are kind of putting two and two together. That, and the government has been, modelling these changes with Treasury. They've been seeking advice from industry experts, which not from me, unfortunately. I haven't been called upon, but the sense is that they are looking to tweak the discount to the capital gains tax concession. Negative gearing, I'm not so sure about. There are some economists who don't actually believe that it does have that big an impact, and it's more the CGT discount. So I anticipate that it will be reduced, maybe to 33%, maybe to 25%. But key details like whether or not it will be grandfathered, so whether it will apply to just investment properties purchased going forward, I'm not quite sure about that detail.
That's the answer, I think. As a property investor, that's the biggest one for me. And then the wildest thing will be, if there's then a window that you could sell or not sell in, the grandfathering part of any of these changes will be the biggest one. And like I say to anyone, when you talk about negative gearing or even capital gains tax, whether it's interest or tax, that should be the last part of your planning. It should really be about the growth side of the thing. And obviously you're only paying tax if you're making money. So I think long-term property will always be strong. Around the markets, I think our regional markets are probably less of a conversation today because so much is happening in the world. We are really affected by tourism on the mid-north coast. So coming from on the grounds, I've got 2 accommodation businesses. I've got takeaway businesses and cafes, and plus we've got more than 500 holiday houses we manage. We have seen a softening this Easter. We saw a very good Easter productivity, so very high rentals, but the shoulder seasons are a little bit softer this year. And I mean, great data, but even watching at the supermarket, the cheaper cheeses are selling more expensive than the premium cheeses. So this type of data I think is so important. I know CBA, I think out of anyone gets more of the TAP data. It'd be great to hear more from them. What are you seeing in relation to tourism?
Well, in relation to tourism, the data is a little bit lagged. The Destination New South Wales website has some really good stats on this, but they're sort of updated to last international tourism through 2025, so a 6.1% increase in international visitors over the year. The average length of stay was up 28%. to 16 days, and expenditure was up. But lagged data, 2025 was an era of falling rates and improved economic performance. This year, I think we can expect less international visitation, not just because of the cost of international flights, but also just consumer sentiment changing, people really wanting to stay to save money. But that could also bode well for the North Coast because it is the number one regional New South Wales destination for domestic tourists. And it is a relatively cheap way to enjoy, whether that's a out-of-city escape, a couple of nights up the coast for special occasions. So I think domestic tourism could actually be the alternative for a lot of Australians rather than a big overseas trip this year.
Yeah, I don't know if it's right to do, and maybe it's a bit of panic, but I talk about like COVID type conditions. And this sort of time that we're through seems to have some similarities of how we thought about or how things might have happened. So obviously when COVID happened, no one travelled overseas, and mid-North Coast and Northern Rivers were absolutely slammed. So I think we're in a little window that people are trying to see a reset. I think there's always a window of uncertainty where people just sit on their hands a little bit. And I think winter's always a little bit slower, but I think we'll have a very good, my gut feel is we'll have a very good spring because what people still do need to go away. I think less people probably will go overseas. We're probably not affected as much as international tourism. We're not Sydney, we're not Gold Coast, we're not Melbourne. So I think if people aren't coming here, then our people aren't going away. So I think, good times ahead for our tourism market. I've got really deep in this current market. We've got a big business. A lot of our clients rely on us. Our team relies on us. I've been more politically watching, this time, and as I keep saying that word of COVID, crazy times make you think a lot. My vibe is that we're going to have a period of uncertainty, and then the mid-North Coast and Northern Rivers because of our affordability. I talk about like Gold Coast and Brisbane have got, once upon a time when 10 years ago I moved to Port, there was a time where you could live, a 20-year-old carpenter that wanted to chase the surf would go in parts of the Gold Coast afford. That can't happen anymore. So I'm talking about that we're going to see a Brisbane Gold Coast push down, and obviously we've got a Sydney push down. So I'm very optimistic for our region and our market. Also think with the shortage of property that once we get through this time, I might be a little bit optimistic, but I think we're going to see some good times. What's your vibe?
Yeah. Well, my vibe is that scenario you described sounds glorious about being a 20-year-old carpenter who's catching the surf. So I'm sad to hear that. I'm like,
that's
what have
I
done with my life?
Northern Rivers and Mid-North Coast.
Sounds glorious. But yeah, I think the trend is definitely for the affordable segment of the market to persist, definitely reflected in the data. If you look at the quarterly growth trend for the top 25% of values in New South Wales, they fell in value over the quarter. They were down 1.3%. If you look at the bottom 25% of the market, they were up 2.5%. So you've not only got things like the expanded 5% deposit scheme diverting demand to below the $800,000 price cap for regional New South Wales, but you've also got downsizers who are looking to, maximize the money that they have for retirement. You have investors who are probably as you say, in light of potential changes to investment properties, maybe looking for higher yield, positively geared opportunities, and that tends to be found at the bottom end of the market as well. So, and even just looking at the cycles, the low end of the market holds up much better than some of the high-end properties, which can experience volatility. And at the end of the day, it's property, it's bricks and mortar, it's a relatively stable, slow-moving asset that I think people turn to in after the initial shock.
Yeah.
When things settle down, I think they look really attractive. So areas like the Mid-North Coast, Coffs Harbour, Grafton, where you've got over half the properties sitting under that $800,000 price threshold, could bode really well in 2026.
Yeah, we've seen the buyers agents. They've been in different markets, but they've turned up at the moment. They're in Kempsey and they're in casino. So it's interesting to see where the buyers agents are. I'm currently sitting in Ballina right now. I'm doing this podcast, and in this area, you've got the hinterland, you've got the Byron market, you've got East, you've got Ballina, you've got Austinville. Like they're all markets within a market. Whenever I'm at a barbecue and someone says, "How the market, Dave?" I'm like, "Well, no. What market do you want to enter?" So I think more than ever, now's the time to really spend time on your market and what you're looking to buy, because there might be some fear, but this could maybe be the right time to be buying in your market. And also it depends on where you're selling and what you're doing there. So I really think, and I really push people, is like, if I'm looking to buy in an area that I don't know, real estate, like I know there's a lack of trust with real estate agents, but you need to go and find the ones you trust, and you need to go and speak to them about that particular area you're looking at, because within a kilometre, it can change so much. I think the other thing I'm saying to people at the moment is, say $1 million is your budget. If you buy now, who knows? Maybe it could come off 5% and it might be 950, but it's not going to change your life. But if you can afford $1 million and we get it wrong, like who would have thought COVID would happen? And with the shortage of supply, the market does jump and all of a sudden it's 1-1, 1-2. You've missed the boat. So especially around your family home, like if you've got 4 or 5 investments, then maybe consider in your hands. But I always advise people, if it's a family home and you can afford it, it's always the right time. To finish off your view on that, obviously economist is probably a little bit different from a real estate agent, but your view on that advice, if a friend's asking you, is it the right time to buy or not?
No, I'm 100% the same. It's like, what are you looking to do? Are you looking for short or long-term capital growth? Are you going to live in the property? I think, like we were saying at the beginning, if you are someone who is well capitalized and you're interested in a counter-cyclical move, then the high end of the market might actually be something that you look at as interest rate rise, because that presumably would be more interest rate sensitive, take a bit of a dive, and then that actually becomes a window of opportunity. If you're someone who's looking for that short-term gain in equity, maybe you're a first home buyer with a low deposit, then you are going to be looking at that lower end of the market, of course. But at the end of the day, we're a little bit boring when it comes to our lending, right? We're very conservative. You're stress tested on a 3 percentage point increase in interest rates, which, by the way, is not we're not anticipating a 3 percentage point interest rate in the cash rate. Yeah. So at the end of the day, the financial stability is very strong. We're underpinned by an incredibly low arrears rate. And even if the unemployment rate does go up in Australia, some economists are saying to around 5%, that's still lower than the pre-COVID decade average of 5.5%. So from that perspective, I think property still looks really good because it's underpinned by so much financial stability. But as you say, what you invest in is going to depend very much on your individual strategy.
Yeah, and to finish off, that unemployment from a business owner's point of view, last 3-4 years, it's been so hard. Like, as I said, run multiple businesses from supermarket to takeaways to the real estate business to finance, all these different types of businesses. Employment's been impossible. It just seems like it's lightening up. And if you want to grow, like I have other ideas, I want to grow. And one of the scariest things about trying to grow is just being able to get staff. So I don't think that's a bad thing. So I know I've got you next month. Let's dig deep, depending what happens in the world. But I'd really love to get into Mid-North Coast business and let's talk about that employment bit. But for today, I want to thank you so much for sharing. Hopefully from the data and the science and the brains of an economist to everyday real estate agent out in the field, our listeners can get a little bit from this. So thank you.
Yeah, thank you so much. And let's not underestimate the brains of the real estate agent either and your knowledge. You're being very humble there. But no, I think it's good to have both insights for sure. Thanks for having me.
I promise I didn't pay Eliza to say that. See you guys. Have a great day.